Okay, we are live. I think we're live. Testing, testing. Okay, it sounds good to me. If anybody has a comment on the sound quality, I would appreciate it. I'm coming through okay. Yeah, I think we're good. Okay, I'm just gonna wait a couple minutes for people to filter in, and then we'll get this thing rolling. Okay. Okay. Oh, is my chat messed up here? No, I think we're good. Okay. Hey, Okaje, how's it going? Yes, I was able to access. I tinkered around with it a little bit. I mean, I think I'm using it right. I'm not the most familiar with how it works. So maybe I can actually. Ooh, do I want to pull it up? Because I actually have the company in there. I guess it's okay. Well, hey, how about this? At the end, if you want to stick around, we can look at it together, and I'll pick your brain on it a little bit and make sure I'm not missing something. But yeah, I was having issues at first with permissions, but did get it working. Okay. Nice. Okay, so just try typing the ticker symbol to get started. So for me, when I did it, and this is why I'm worried I was doing something wrong, I had to actually take your prompt. Like when I downloaded it, it looked like it was giving me a prompt. And so I put the prompt into Gemini, and then it asked me to, like, let me back up. So on your link, I tried to open it with Gemini, but it didn't seem like it had anything pre-loaded. So I entered in your prompt, and then it said, okay, now give me a ticker. I gave it a ticker, and it seemed to do everything pretty well. I haven't tested it a ton yet, but it was like, I mean, it was pretty close. It was using a slightly different discount rate than me, which I need to also check. But yeah, it looked, I mean, for the most part, it looked pretty good. I only checked the one company though. So anyway, for this week, I'm pretty excited about this company. There's just so many opportunities in the market today because of fears around AI, an AI bubble popping, companies crashing because their business model is at risk of AI. There's just a lot of fear in the market, and where there is fear, there is overreaction potential. So what we're looking at today is Pinterest. On February 12th, Pinterest dropped from $18.60 to $14.29. If I look at the 3-month view, or sorry, just the 1-month view, it's dropped nearly. It's recovered a little bit today, but when I originally looked at this and made my thumbnail for the stream, it had dropped 40% in a month. And when I see a company dropping like that, I go to the financials and I expect to see, some evidence of poor performance, but this company continues to make more and more money. When I go to the cash flow statement, they continue to increase on average their operating cash flow every single year. One thing I will touch on is their stock-based compensation is pretty high, so we do need to take that into account. But when I first looked at this company, I couldn't believe that it is crashing so much. And of course, the question is, why especially did it crash so much recently? So one of my favorite places to look to get that initial view on what's going on with a company is Morningstar Equity Analyst Report. The equity analysts for Morningstar do such a good job of summarizing what's happened. So this information is as of February 13th. It's up to date. Pinterest reported a solid end to 2025 with fourth quarter sales growing 14%, adjusted EBITDA margins flat. Strong results, though, were more than offset by weak guidance for the upcoming quarter. So the firm is projecting sales growth to be 12.5%, which is weak. That is less than what people were expecting. But keep in mind, growing by 12.5%, that's still good growth. So what it looks like to me is investors were putting Pinterest on this pedestal, thinking that it was going to be growing by so much, and then it didn't quite hit those growth metrics, and now it has dropped by what we said 40% in 1 month. So this is the opportunity. Why it matters: Pinterest results, along with those reported by Alphabet, Meta, Reddit, Snap, underscore the strength of the digital ad market. At the same time, we are seeing a divergence in monetization, with larger players gaining more market share. We attribute this divergence to Meta and Alphabet's ability to invest in AI tools and improve its effectiveness. Smaller players like Snapchat and Pinterest cannot undertake the same investments due to high costs, so they continue to see their monetization rates lag. While Pinterest is investing in its AI capabilities, particularly its automated ad campaign tools, we don't see it closing the monetization gap. So another important point is that along with the weak guidance, Morningstar is citing a lack of investment, or I shouldn't say a lack of investment, but just they can't keep up with the big dogs' investment. So the bottom line is we are lowering their fair value significantly to $22 from $35. So Morningstar is doing a significant lowering. They do say this company has a narrow moat, reflecting slower than average revenue per user growth, with shares falling 19% after hours. We consider them to be undervalued. So just for the record, Morningstar does consider this company to be a 4-star. That means undervalued company, narrow moat, high uncertainty, standard capital allocation. So that is Morningstar's outlook. But besides the synopsis, I also really like to use Morningstar for its analyst projections, but we're going to get to that. So, okay, Morningstar cites divergence in ad monetization. Another place I like to go to get a feel for why the company is not performing as well as investors thought is, of course, the Q&A session, the most recent earnings call transcript. And what jumps out to me the most, what gets referenced the most by Pinterest management is actually, believe it or not, tariffs. Okay, while we absorbed an exogenous shock this year related to tariffs, which are disproportionately affecting ad spend from our top retail advertisers, this quarter also underscored where we need to move faster. So to deal with this, they want to broaden their revenue mix because what am I trying to say? Where did I read it? Their top retailers are being affected more, so they need to broaden their scope a bit. The next reference to tariffs Many of the largest retailers have been disproportionately impacted by tariffs and have been pulling back on advertising spend across the industry as they seek to protect their margins. Our higher mix of larger retails relative to some of our peers has resulted in us feeling more of the impact. So Pinterest is painting a little bit of a different story. They're saying that their specific profile of retailers is disproportionately affected by tariffs. And to me, that does make sense. I haven't spent a ton of time on Pinterest, but people go to Pinterest a lot of times to buy things, to find, cute items, to how to decorate a room. That's Pinterest is used a lot in that case. And so if you're trying to buy a lot of these things are manufactured and imported from other countries, and tariffs would have a pretty large impact on those things. Next reference of tariffs. Again, we acknowledge that revenue performance we put up in Q4, while pressured by tariffs and our greater mix towards larger retailers, while that was presented some near-term headwind, the long-term commerciality, am I saying that right? Commerciality of the platform, the very significant volume of search activity that we're getting, the high commercial intent, and our ability that we've now proven that we can drive performance advertising budgets gives us confidence that this really is about how we get that performance to a broader set of advertisers through sophistication. Okay, so basically what they're saying is that this is a near-term headwind, but the company is still very confident in their long-term commerciality of the platform. So different story from Pinterest. They're saying this is a short-term deal. And so now we have to ask the question, how long are these tariffs going to last? I'm going to be honest, I don't know. It's hard to judge what the current administration is going to do. It's a little bit erratic. Things change very quickly. But what I do think is that the tariffs that we have set in place are probably not permanent as we work out trade deals with other countries. I think in the long term, tariffs are going to come down. I think generally speaking, having higher tariffs are not very good for the economy, and that in the long term, as we get the trade deal set in a way that is mutually beneficial to both parties, at least in the eyes of our administration, I think we're going to move towards lower and lower tariffs. So in my mind, the tariffs are a short-term headwind, and the company is losing big-time valuation, even though the problems are in the near term. We're going to say we'll say a couple years. So as long as we are taking into account those headwinds and being conservative enough with our projections, I think we can do a discounted future free cash flow assessment on this company and potentially have a good opportunity. So let's get into that. Let's get into the discounted future free cash flow evaluation. So the first thing I want to look at, I've got Pinterest in here. This is my automated discounted free cash flow valuation spreadsheet. The way it works is I put in the ticker. This spreadsheet will automatically pull information from stockanalysis.com. On the data entry tab, it just pulls it all in here. And then on the data formatting tab, it gets it nice and pretty so that it's easy to pull those numbers into the calculation tab. And then after the calculations are made, it gets spit out onto the dashboard where we have a set of assumptions that we do have to enter in on our own. So the first major assumption I want to look at is the free cash flow margin. One of the biggest things about doing a discounted future free cash flow evaluation is, number one, what is the future revenue going to be? And then number two, what percentage of that revenue is Pinterest going to be able to turn into free cash flow? So the main way, there's two things that I look at: past performance and the past trend, and then the analyst projections for future profitability. So past performance is not a guarantee of future performance, but a company that has been trending in a certain direction is more likely to continue trending in that direction. So, a company that's been performing very poorly, it's less likely that company is going to suddenly start performing really well. Whereas a company that's already shown that it can perform well and is trending in a good direction, there is such thing as momentum, and I think it is more likely. So, it's important to take into account past performance. So looking at past performance, if we're just going by how stockanalysis.com, this is my favorite website to bring up financials. If we just go to stock analysis free cash flow, it gives us a free cash flow margin in the over the last 12 months of about 30%. But that is way too high. That is way too high because the way stockanalysis.com calculates the free cash flow is they take operating cash flow and then they subtract capital expenditures. And that's it. But if we dive a little bit deeper into how this operating cash flow is determined, we see that 880 million of this operating cash flow comes from stock-based compensation. So this is an expense that the company had to absorb, but it's not a cash expense. So while it did get taken away from the net income, that money gets added back in when we're actually calculating the cash flow. So that big stock-based compensation, that's pushing this number up. And if we scroll down a bit further, we can see that they actually used a lot of cash to repurchase stock. So they saved cash here, but then they used it down here. So I'm counting this 880 million against. So that's going to reduce this free cash flow margin significantly. So that's one of the adjustments. That happens in this table right here. There are a few additional assumptions. I have to decide what percentage of R&D I want to give them credit for, what percentage of CapEx I want to give them credit for. If I want to take away any points for acquisitions, because sometimes if a company is increasing their revenue by just making acquisition after acquisition and they're not really synergistic, they're really actually maybe even hurting future free cash flow margin, then I would count acquisitions against. In this case, Pinterest does not spend a meaningful amount of money on acquisitions, so I'm not going to bother with that. And then finally, I'm counting 95% of stock-based compensation against. So in this case, the new average free cash flow margin is 5.5% for the last 5 years. However, most recently, their free cash flow margin is about 10%. Now, this is not giving them any credit for R&D, and it's not giving them any credit for CapEx, even though Pinterest is investing money, R&D money and CapEx money on their artificial intelligence. And they do have a unique artificial intelligence that is trained on the visual data from the Pinterest website. They get tons of traffic and there are tons of data points. So they are able to track a user's taste, what a user likes, based on visual information, and then be able to advertise accordingly based on that visual taste data. So they are, like we can see here, 30 in this is the percent of revenue that they spend on R&D. So they spent 1.4 billion on R&D in 2025. That's 34% of their revenue. So they are spending a significant amount of money, 22% of their revenue on CapEx. So they're spending a lot. They are investing. So in reality, I should be giving them some credit for this. It's hard to say exactly how much. They don't really break it down how much of their spending on CapEx, let's say, is for maintenance versus growth. And for their R&D, they don't really break down what percentage of that spend is going to be creating more free cash flow in the future versus what is required of them to continue doing just to maintain their current amount of revenue. Like, it doesn't give us a nice clean breakdown. So I like to err on the side of caution. I'll put 10%. I'll give them credit for 10% of their R&D spending is giving them growth, and then the other 90% we'll say is giving them maintenance, and we'll do the same thing for CapEx. So with this new assumption, the average is 9%, and over the last, since 2022, they've been trending up in terms of free cash flow up to about 13%, which is quite a bit lower than what stock analysis shows as their free cash flow, which was 30%. No, we're saying 9% on average. So that is where this 9% comes from. Now, the next cell that I'm looking at is their free cash flow margin growth. Are they going to be more profitable as we go forward? And to get that answer, I like to use, once again, Morningstar Equity Analyst Report. So now this time, let me scroll all the way down and right here. Okay. So they give, and these projections are as of February 12th, 2026. So these are very recent. Their revenue growth over the next 5 years from 2026 to 2030, they're saying they're going to grow at about 9% on average per year for the next 5 years. So just skipping ahead a little bit, that's where this cell came from. I put 9%. This is annualized revenue growth for years 1 through 5. But going back to the free cash flow margin growth, how are we going to determine that? So they also project, on top of revenue growth, they also project operating margin, EBITDA margin, net margin, and free cash flow margin. So let's just say 2025. So in 2025, operating margin was 10%. The forecasted operating margin is going to be 20% by 2030. So Morningstar Equity Analysts are saying their operating margin is going to double over the next 5 years. For EBITDA margin, it was 10% in 2025. Morningstar is saying it's going to be 21. That's also doubling. For net margin, 12.6. Morningstar says it's going to be 21. And then finally, free cash flow to the firm. So Morningstar actually says 8% free cash flow margin to the firm in 2025. So they're marking quite a bit against. I'm not sure how they come to this number, but I'm more using this number as a starting point. And then looking forward, they're saying 16% by 2030. So once again, Morningstar is saying margins across all levels from the top to the bottom are going to be doubling over the next 5 years. So how am I going to represent that growth? I'm going to say 1% growth every year for the next 5 years. So initially it's 9, the next year it's going to be 10, then 11. So I've got this the margins growing by about 50% over my projection period, whereas Morningstar has theirs increasing by 100%. So I'm definitely building in less margin growth than Morningstar. I'm trying to be a little bit more conservative. But moving right along, 9% in terms of revenue growth for the years 6 through 10. Oops, I just realized I have this swapped. For years 6 through 10, I have 4%. Let's make this 4.5. My rule of thumb here is I take the revenue growth over the next 5 years, and then I cut it in half for years 6 through 10. And again, this is just to be conservative. I just want to make sure that I'm not overshooting. It's really hard to project a company's revenue growth 6 to 10 years out. Analysts don't really do it. So I just want to put an assumption in there that I'm confident Pinterest will exceed. It's probably going to be closer to 9% revenue growth for those years, but I'm setting it to 4.5. And then as my perpetual growth rate, I put it roughly equal to inflation, which is 3%. For my discount rate, this is the return that I want every single year, the minimum return. And then based on these assumptions, in order to get this minimum return, this cell right here gives me my projected fair value. So according to these assumptions that we walked through one by one, oops, that's the past, this is my projection right here. I'm saying the fair share price, if these assumptions are correct, is $25 per share. Morningstar said, what did they say? They lowered theirs recently. They brought theirs down to 22, right? Okay, so Morningstar says 22. I'm saying 25. Now, let's look at these cells right here. Average, so these are analyst projections. So where the analysts come into play here is I go to stockanalysis.com. I go to the forecast tab where they aggregate many different analyst projections, and I copy these analyst projections for revenue growth over the next 5 years. I just copy that. This is a high, average, and low. I typically look most at the average analyst projections, but I copy that into this cell right here. Oops, sorry, getting a call. Okay. Sorry about that. Okay. So I paste those into these cells right here, and that is where these calculations come from. So this is using all of these assumptions here. However, it's not using this annualized revenue growth for years 1 through 5. Instead of using this assumption, it's using the analyst assumptions. So based on those revenue profiles, we're seeing the lowest analyst revenue projection giving me a fair share price of 20, which is a 19% upside. And then the high range is $41 a share, which is a 153% upside. So based on the discounted future free cash flow assessment, I'm seeing massive potential upsides. And I don't see these assumptions that I've made as being out of the ordinary, insanely high. These are in line with what the analysts expect Pinterest is going to do. So the next thing I like to look at is I want to start reducing the assumptions until I arrive at today's current share price. So first of all, let's say we reduce the margin expansion to just 0.5% per year. That cuts my projection down to $21 per share. This is more in line with the Morningstar Equity Analyst Report. If I also reduce the revenue growth down from 9% over the next 5 years to 5%, that reduces me to a 13% upside or margin of safety. And then finally, if I reduce this to 3% and this to 2%. Okay, so now we've reduced all of our assumptions And we are seeing basically a fair share price today from this new set of assumptions. So this is what the market thinks is going to happen. Do we think, do you and I, do we think that Pinterest can exceed this? If the answer is yes, then our expected return over the long term, over many years, should be higher than 8.35 per year. This is what we are going to exceed if Pinterest can beat this set of assumptions. Hokage says, very good find. If time permits, maybe we can also take a look at Snap and Reddit. Interesting you brought up Reddit. I've already looked into Reddit extensively. I have not really looked at Snap yet, so maybe we look at Snap. Reddit's coming on a video already, so good find. Okay, so in my mind, Pinterest is looking pretty good, and even by reducing a lot of the assumptions I did, if we then use the analyst spread, even the lowest analyst only put me at negative 10%. So Pinterest is looking really good. Now, full disclosure, I actually bought into Pinterest this morning. I went ahead, like when I finished my research, I went ahead and just put in the buy order for this morning, and I'm glad I did, because today Pinterest recovered a little bit. So yeah, so I'm already up 5% on this particular investment. So anyway, it's always nice whenever the morning that you buy, it immediately goes up. So anyway, not that I'm trying to time it. I am not trying to time the market. I'm simply looking for companies whose share price implies a performance that is much worse than what the analysts think they're going to do. You know, I look at what is the analyst consensus. These guys, they make it their business. It is their profession. They spend their time analyzing companies and trying to come up with a reasonable set of assumptions or projections for a company's future. And if the share price is much lower than that set of projections, then I feel that it is giving me a margin of safety. It's making me more likely to make money on that investment. So that is my rationale for this company. A couple other tabs I wanted to look at. So just in case you are not familiar with what exactly Pinterest does, how they get their money. We generate revenue by delivering ads on our website and mobile application. We recognize revenue only after transferring control of promised goods or services to customers, which occurs when a user clicks on an ad contracted on a cost per click basis, views on ads contracted on a cost per 1,000 impressions or cost per day basis, or views a video ad contracted on a cost per view. Okay, so I feel like I stumbled over my words a bit there, but you get the idea. They make their money off ads. The more people that come to the website and browse through different people's pages, the more money that this company is going to make. If I go to their earnings report presentation, scroll down a bit, revenue, monthly active users. So over the previous 4 quarters, or actually this is showing the last 5 quarters, they have increased their monthly active users by 10 to 12% every quarter. Q4 of 2024, Q1, Q2, Q3, Q4. So this is 5 quarters, and it's just showing the breakdown by region. The majority of the traffic of the active users is actually in the rest of the world, not even in the US and in Canada, just to point that out. So international user base, growing monthly active users every quarter. They are just suffering on their monetization because of tariffs. As companies' margins are being compressed by tariffs, where are they going to start cutting costs? Advertising is one of the first ones to get cut a little bit, which is going to affect Pinterest. So that's what we're seeing there. Anyway, that was the main thing I wanted to point out on their earnings presentation. And then on their press release right here, on their most recent guidance, let's see. Forward guidance for Q1 of 2026, we expect revenue to be in the range of 951 million and 971 million, representing 11 to 14% growth year over year. Our guidance assumes the impact of foreign exchange to be approximately 3 points of tailwind based on current rates. So even though they're expecting revenue growth, their stock price cratered. Adjusted EBITDA expected to be in the range of 166 to 186 million. So this is the company I'm looking at on my public YouTube portfolio series this week. I'm investing $200 into Pinterest. I believe it to be undervalued. And every week on my public YouTube portfolio series, we invest in at least one new company, and then we put $50 into an existing company that I believe to be particularly undervalued. So let me pull up the portfolio really quick. We are beating the S&P 500, although our portfolio is not very old. We've only been doing this for a little over a year. So you can't conclude too much by saying that, oh, we're beating the market, because this is a long-term portfolio. I am measuring my performance over many years, not over months or even 1 year. The goal is to beat the market over many years, and companies can be undervalued for a long time. That's possible. I can buy into a company and it can be undervalued for a couple years before the market finally realizes, oh my gosh, this company is doing much better than what we gave credit for. So let's look at the performance. Oh, and here's our curve. This is our dollar amount going up over time. We have $9,200 invested, and really looking forward to hitting the $10,000 mark. Like I said, this year when we first started for the full first year, we only invested about $100 per week. Now we're doing $250 per week, so we have upped the ante a little bit. But if we view benchmarks and compare our performance to SPY over the life of our portfolio, we are up 17.66%. SPY is up 15.5%. So as you can see at the beginning, we were very volatile because we just had just a few companies every week. We're adding more and more companies. And now we've started to mirror a little bit the performance of the S&P 500, but the goal is to beat it over the long term. If we look at our holdings, we can see, let's sort it by gain here. Most gain to most loss. We have 52 positions. And if I scroll down to the bottom, we do have some in the red, some big ones in the red. These are the ones that I'm going to be looking at that have fallen in the near term that I'm looking to invest an additional $50 in. The company that I'm investing in this week is Adobe, which we're going to look at that a little more closely in a minute. But we have other companies that have dropped way more than that. The Adobe is actually, and I've been putting $50 into Adobe the last couple weeks. I just love Adobe right now. And we're going to look at some of the reasons for that in a minute, but there are some other companies that have dropped by even more in total. So Simply Good Foods, we've got $110 in there. It has dropped by 50%. Hims has dropped by about 38%. This was one that we had some of our biggest gains on early in the portfolio. And thankfully, we trimmed that position down at the beginning of the year. So we were able to capture a lot of the gains and not lose all of it. But we are still holding Hims because it is still undervalued. And PayPal down about 29%, and Nice down about 29%. These are our four biggest holdings. These are some of the companies I'm going to be looking into a little more closely in the next couple weeks, looking to probably double down in some of these. But like I said, for this week, I'm going to put $50 into Adobe. And then also Uber down 20%. So we've got some companies that are down by quite a bit here. And then once we get past Adobe, these companies here are down by less than 10%. So I'm less focused on these. These are recent purchases. And then companies that we need to be looking at as well to see if we need to sell, if they are now overvalued, are Plab, Google, BTI, UHS. Now, I did look at a lot of these pretty recently, and they all still appear to be at least fairly valued. So not planning on making any sells anytime soon. But it's nice to see that we are, for the most part, most of our companies are roughly flat or up by quite a bit. We do have a few that are not performing well in the near term, but I still have confidence they're going to perform well in the long term. Okage says, Akame doing well, Iridium slowly recovering, Simply Good Foods keeps getting beaten by economy. Yep, that is about right. It is nice to see Akame doing well. They were down for a long time, and we doubled down on Akame. This was one right here where we knew what we found when we initially invested. It was basically down and flat for a long time. And actually on our portfolio, we can see what we bought the share at. If we go to activity, symbol, we go ACAM. Okay, so we bought initially for $100 on February. We bought 100 more in February, and then we bought more in May. So February and May of 2025. Oops. And then we sold a little bit off. Let's see, February and May. So let's see, February. Oh yeah, back here. So we bought over here, and it dropped a lot, and then we bought more in May. So that would be over in this region here, more at 70 range. So thankfully, it has popped off since then quite a bit. Anyway, okay, so Adobe. Let's look at Adobe really quick. I'm going to just very quickly cover Adobe, why I want to put a little bit more money into Adobe, just $50. So first things first, let's put in the ticker here, ADBE. Let the automated spreadsheet do all the hard work. Past free cash flow margin is the first thing I want to look at. 40% is the free cash flow margin for Adobe before we make any adjustments. So if I let's put in 0 credit for R&D, 0 credit for CapEx, even though Adobe is making investments into AI. This is a fact. I'm just starting with 0. This is my baseline. This puts their free cash flow margin at 32%. So let's put that in here. So we have dropped their average down quite a bit from the adjustments to stock-based compensation. We're not going to put in any growth for now. On the Morningstar Equity Analyst Report, let's just scroll down to the section where they make their projections here. Bear with me. Oops. Okay. Revenue growth over the next 5 years, 9% for Adobe. So let's put in 9. Once again, we're going to cut it in half for the next 5 years, and then 3% for perpetual growth rate. So initially, without giving any free cash flow margin growth, just looking at my projection, I'm seeing a 78% upside on Adobe. That's with an 8.35% free cash flow, discount rate. So 78% margin of safety. I should be able to get this return. I love Adobe. Also, if I go to my Buffett supplement right here, this automatically looks for red flags that Warren Buffett looks for. I read one of his books on analyzing the balance sheet, free cash flow statement, and income statement. And these are some of the ratios that he looks for red flags or green flags. And Adobe is full of red flags. They've got great margin. They don't spend much on CapEx. They don't have much depreciation. They've got a great current ratio, plenty of liquidity. Retained earnings goes up every year. Goodwill has not been dropping off. Their debt and their cash are in line with each other. They basically have enough cash to just pay off completely all of their debt, which is great. Profits go up every year. And right here, this is looking at margins and expenses. Everything looks great. So Adobe is a really strong company. Whenever I go to their financials, one of the things I want to point out here is how they spend their cash flow. So in 2025, they brought in $10 billion in operating cash flow. Very small CapEx spend, 180 million, we'll say. They spent $1 billion investing in securities. They issued a little bit of debt. They brought in $500 million more of debt. They issued a little bit of stock, but they bought back $11.7 billion in stock. So this company is buying back their own shares, which at a time, so this company has been undervalued for a couple of years now. They've been spending tons of money buying back their shares while their shares are undervalued. So in my mind, this is a great use of their cash flow, assuming they are able to keep up their revenue growth and their margins. If that is going to hold true, this is a great use of their free cash flow, because if we go to their income statement, we can see how many shares outstanding. Their shares outstanding has been dropping off every single year. Over the trailing 12 months, they bought back 5% of their outstanding shares. This is basically having a 5% dividend, and then I turn around and I use that dividend to buy more shares. That's kind of how this works, except I don't have the tax hit of getting a dividend. So this is a more tax efficient way for Adobe to return money to me, the shareholder, as long as they continue to perform well. If this company does not go on to perform well, then these share buybacks might be a little bit of destroyed value. And maybe I would have been happier just receiving the dividend and then diversifying that into other holdings. But if our assumptions hold true, Adobe is undervalued and they do continue to perform well, then the share buybacks I really love. So a lot of ifs there, a little bit of a hedging there, but in general, for an undervalued company, I like to see the share buybacks. So this is cash flow. This is operating cash flow, free cash flow being returned to me, the shareholder. Love to see it. Okay, so that is the company that we're we're putting an extra $50 in this week. Let's go back to the portfolio really quick. And okay, so we've got this portfolio set up by sector. And then I have one extra category here for my small cap companies that have super low trading volume. I like to keep them separate. These are the ones that I think have the most upside, but also have a little bit of risk. Being very small cap companies and being very low trading volume, they are susceptible to, large price swings. So I like to keep that category separate, just so I can see at a glance which companies are doing really well, which ones maybe represent a great opportunity to buy in more, or maybe I need to get out. So none of them are too crazy right now. We have Vermilion Energy and PPAC, Gladstone Financial Corporation. These are the two that are performing the best, up 25%, which is great, but nothing that we are looking to sell or buy more of at this time. So been very happy with this segment in general. Anyway, so next thing I want to do on the channel is look at viewer recommendations for companies. So Hokage brought up Snap and Reddit. So I do want to check those companies out really quick. Let's see. So Reddit, like I already said, I actually have a video coming out on Reddit. So I'm not going to look at Reddit. A little bit of a spoiler alert. I think Reddit does appear to be undervalued. So let's just skip over to Snap. What has Snap been doing? Over the last 3 months, down 40%. Could be a really great opportunity. Let's go to the financials really quick. And let's look at their cash flow statement. This is a lot of times where I like to start with a company, is to see how does their cash flow look. They are not profitable, so their net income is negative, but they do appear to have positive operating cash flow, and they do appear to have transitioned to positive operating cash flow somewhat recently. So after 2020, or I guess at 2020 and before, they were negative in terms of their operations, but now they are cash flow positive. They do spend a significant amount of money on CapEx compared to their operating cash flow. And they have a significant stock-based compensation. So this is a big red flag right here. So they have operating cash flow right now to the tune of 600 million. But if because of this, they really don't have, in my mind, they may not actually have operating cash flow because there's, okay, so look at this. So in the trailing 12 months, they spent $750 million buying back shares. So more than what they brought in from their operating cash flow. They had to take all this operating cash flow and they had to buy back shares, and they still diluted the company because they issued $1 billion worth of shares. They were only able to buy back, they only had the cash to buy back 750 million of it. So how are they getting the cash? They are issuing debt. So they issued $2 billion in debt. They paid back $2 billion in debt. And they repurchased 750 million in stock. So in terms of their financing, they actually put money, a lot of money into buying back, paying off debt and buying back stock. But I guess their debt is basically, they basically rolled it forward. They paid back 2 billion and then they issued 2 billion. So they rolled their debt forward. They did use cash to buy back shares, but $1 billion they used on compensation. So $600 million came in from operations. $173 million came in from investing. So what they did here is they sold previous investments. So we can see that they invested $522 million last quarter, or over the fiscal year 2024. But in fiscal year 2025, they sold $431 million of their investments in order to fund operations, buying back shares, paying off debt, or really just rolling debt forward. So what I'm seeing here initially is that Snapchat it's going to show that they have free cash flow on paper, but they really don't. They really do not have free cash flow yet. So we can see right here, it says free cash flow 437 million, but I'm saying no, they actually have zero. They actually have zero free cash flow right now. But that doesn't mean that they're out necessarily. It does not mean that they're out. It could mean that what could be the case is that they are in the process of becoming free cash flow positive. And once we model that out, it could be that their shares are still incredibly undervalued. That could be the case. I'm just saying initially it looks to be a bit of a red flag. So let's put it in the calculator. Snapchat. What do they have to, I guess here's the question. How much do they have to grow their revenue and their profitability in order to be fairly priced today? Okay, so yeah, currently they have the negative margin. Let's give them, let's just give them some credit though for R&D. We'll do the classic 10% and 10%. That puts them at -5. So we start at -5. We say that they're going to grow their free cash flow margin by 2% per year, every year. If we look at the forecast tab to see what do the analysts think they're going to do in terms of growing their revenue, we can add this into the spreadsheet as well. So quite a big spread on the analysts here. So it diverges after 2026. So the analysts are in agreement that they're going to make more revenue in 2026. But then as we get further and further out, there's a bigger and bigger spread between the high and the low. So just something to keep in mind. So but we'll copy that, put it into the spreadsheet. Okay. Okay, so based on this assumption right here with a growing growing margin, I should probably change this. So the average is 16 to 6. So we'll just say that for years 6 through 10, we'll say they hit a 6% revenue growth. And we'll say 12% here. So it looks like it's pretty close to being fairly valued if this set of assumptions is correct. So the question though is their margin going to be growing faster than 2% per year? This would put them at a 5% free cash flow margin at the end of my 5-year projection period. It could be that their free cash flow margin is actually much higher by that time. So let's see. Let's put in Snap on here. Let me pull up Snap on my Charles Schwab really quick. Where is it? Morningstar Equity Analyst. So Morningstar says this is a 4-star. They do not give a moat to Snapchat, but let's pull up the Morningstar Equity report here. So the Morningstar Equity report says Snap reported fourth quarter revenue of $1.7 billion, up 10%, largely due to strength in average revenue per user. Adjusted EBITDA margins came in at 21, which is up 300 basis points. Okay, so margins are improving. Despite a 5% year-over-year decline in global daily users, traction in high margin offerings supported top line growth. So there's less people using it, but they have more premium services that's bringing in more money. So their monetization was better, even though their number of users went down. Let's see. Despite solid performance, Snap continues to lag heavyweights like Meta. Let's see. We expect competition to remain high and forecast roughly a 10% annual sales growth over the next 5 years. Okay. So they're saying 10% sales growth. I think I had said 12. So let's go with the Morningstar projection. Let's put in 10. What about the margin growth though? That's what we need to know. Okay, let's scroll down to the margin growth. Or hold on, not quite. Let me actually stop at the fair value and profit drivers. So they say 9% per share. We forecast Snap's sales to grow at 10% over the next 5 years. Do they give any other color on margin? Okay. On the profitability front, we project gross margins to rise as the firm continues to scale. We expect Snap to hit operating profitability by 2029, with near-term profitability unlikely due to the firm's continued investments in product improvements, new features, including AI. Okay. Let's scroll down to the numbers. Okay, operating margin in 2024 was negative 14%. That's interesting. It's interesting that Morningstar says they have a negative operating margin, even though technically, I mean, when I go to their financials, technically their operating margin is... Oh, never mind. Sorry, this is on the income statement. I was going to their cash flow, so that is different. That's a different deal. So yeah, when they're talking about margins, you have to look at the income statement. So their operating income is negative. They have a negative operating income. So they brought in $6 billion in revenue. The cost of their revenue was $2.6 billion. However, they also had selling, general, and admin expenses of $2 billion. They spent 1.8 on R&D, and then they had operating expenses on top of that of not on top of that. This is the sum. The operating expenses is equal to selling and SGA plus R&D. So 3.8 billion in expenses, 3.2 billion in gross profit. So they are negative, but they are going to be improving their profitability every single year, according to Morningstar. So we need to find a way to quantify that. Let's see. Free cash flow to the firm, still showing it to be negative in 2029. So I would say you'd have to build in some pretty aggressive margin growth over the next 5 years. Wow, if we put in 3%, then we are really getting up there. So yeah, I'm going to say that Snapchat appears to be roughly fairly valued just on a surface level assessment. And this is assuming that, they are free cash flow positive, 5% free cash flow margin in the next 5 years. That might even be a little bit aggressive. And even with that aggressive margin expansion, we are still giving a negative 20%, negative 26% downside. So I would, in my humble opinion, I'm going to hold off on Snap for now. It does not pass my initial look. It doesn't look immediately appealing enough for me to do a deep dive. Now, after doing a deep dive, you may conclude something different. After doing a deep dive, you may conclude that, they're going to be more profitable than what this shows, Brian. And that may be the case, but I like to start my deep dive on companies that immediately look really attractive. Okay. Hokage says, I think Reddit is good value at 140 or below. 120 would be a great value. 200 week moving average. Let me pull up Reddit really quick, because when I looked at Reddit, I thought it looked pretty nice. Let's pull it up though. Oh, it's at 147 right now. And over the day they went up. See, should have invested already. But okay, so yeah, the 5 day and the month paint very different pictures. So yeah, over the month they're down 36%. Dang. Okay, what Hokage, you said Reddit is good value at 140 or below. 120 would be great value. Yeah, I think I would agree with that. I think currently they're at a pretty good value. But let's not do a dive on Reddit, because I already made a video on that. It'll be coming out in a week or two, I believe. So anyway, that's what we're looking at. If anybody else has a company you want me to look at, I would be happy to do so. Hokage, if you have another company you want me to look at, I would be happy to do so. But for now, I think that's all I had in mind to cover on today's stream. Happy with the portfolio. Beating the S&P 500, can't be mad at that. We've got 52 different companies, so we are highly diversified. Yeah, this week I'm really excited about Pinterest. I'm also excited to put a little bit more money into Adobe. And yeah, I think for the next stream, I'm going to be looking to put $50 into one of those bottom 4 performers. I'm going to be looking at which of those companies appears to be the most undervalued and start putting some money into those. Yeah, I think we've probably put enough into Adobe at this point. I think I've put $50 into Adobe the last 3 weeks. So I think I need to keep everything diversified. So anyway, yeah, that's all I got. Hokage, thanks for tuning in. Good night, buddy. I hope to see you next week. And then everybody else who is watching and just lurking and not commenting, I'm happy that you guys tuned in as well. I would encourage you, though, to drop some comments. Give me some companies that you want me to look at. I'm always really happy to dive into companies that the viewers, you guys, find, because a lot of my best companies actually come from my viewers. So seriously, I would be more than happy to look into any company that you guys want me to check out live on stream. So anyway, I appreciate all of you. Thanks for tuning in as always. And yeah, next week, same time, Wednesday, 7:30 p.m. That's where I'll be. And I hope to see you there. Cheers. Oh, well, no. Oh yeah. So that's right. Next week, I'm going to be out of town. Tuesday is the stream day, not Wednesday. My bad. My apologies. Tuesday, 7:30 p.m. It's going to be a little bit earlier, but I'll get the stream scheduled a little bit early this time, so it'll be showing up on YouTube so you can see when it's coming up. Yeah, Tuesday, 7:30. Hope to see you there. Good night.